So this is topic 606, and this was finalized after nearly a decade of deliberations on revenue recognition. And in May 2014, they issued 2014-09, the Accounting Standards Update for Revenue from Contracts with Customers. This does affect all entities, and hopefully those of you on this webinar who are CPAs and interested in these topics have heard of this by now, as the implementation deadlines are quickly coming up with December 15th, 2017, so periods beginning after that, so it'll be 2018 for public companies, as well as after December 15th, 2018, which is calendar year 2019 for private entities. The one thing to remember with this is you do need some comparative data, and we'll talk in a moment about the ways that you can implement this standard. So it's not something you can not think about until 2018 or 19. So with that, we'll move on to the next slide. As I mentioned, the transition methods allow either full retrospective application or a simplified method. So as you look at these in particular, full retrospective means you actually go back and restate all the prior periods presented. So you'll restate your entire income statement and any impact on the balance sheet for all the years. And if you're a public company, all 3 years presented, and a private company, typically 2 years would be presented, or a not-for-profit. You can also do the simplified method, but I want you to make sure you can run this adjustment as a cumulative effect through equity in the year of the change, with the prior period presented without this change. However, you still have to go back and look at the previous year and understand the implications of the new standard on every line of your financial statements and show the difference in a footnote. So you have to have the information for the previous year. So definitely something to keep in mind as you'll be accounting for transactions under 2 different methods of revenue recognition during these transition periods. There are a couple of things specifically out of scope of this standard, which includes leases, insurance contracts, financial instruments, non-monetary exchanges, and certain guarantees. And I'll also mention here that the non-for-profit task force has specifically excluded contributions from this as well. But other than that, any other revenue coming through your financial statements will be affected by this standard. So there is a 5-step process to recognizing revenue that is laid out in this standard. And as I said, we could spend days on this, and we're going to give you the 15-minute version. So I'm going to walk you through these 5 steps. So step 1 is to identify the contract with the customer. So a contract has to be present, and it can be written, oral, or implied contract. But as part of this identifying the contract with the customer, you have to have the intent and ability to pay, and collection must be probable. So there is definitely looking at that intention and ability to pay. There's some nuances affecting certain industries, the healthcare industry in particular, that is impacted by that intent and ability to pay. Under step 2, you identify the separate performance obligations in the contract. So when they're looking at and defining performance obligations, it has to be a distinct good or service. So that word distinct is really key in the standard for how you would break out these different performance obligations. Step 3 of the revenue recognition model is to determine the transaction price. So you need to look at, are you being paid a fixed amount? Are there any variable amounts within the contract? Are there any refunds that could be applicable? Are there any non-cash considerations as part of this? Sometimes you may be getting stock or something else that could have a different value that could impact your transaction price. Step 4, you need to allocate that transaction price to the separate performance obligations. And as you go into the standard, it's very clear that when you're allocating this transaction price, you need to look at the relative standalone selling price. So in order to do that, they do give you a couple of different ways to estimate the relative standalone selling price of a good or service. So you can use the adjusted market assessment approach, where you evaluate what the good would sell for in the market and look at that for each distinct piece of the performance obligation. A second way to look at it is the expected cost plus a margin approach. So you look at what it costs you, and then, if your business is getting a 15%, 20%, 25% margin on their products across the board or their services, you can apply that margin approach to the transaction price. And there's also a residual approach, which you can estimate the standalone selling price by reference to the total transaction price and allocate it to the ones that have standalone selling prices, and then whatever's left goes to the remaining elements. So certainly there can be a lot to that allocation piece, and depending on the industry you're in, that could mean even more. The final step of the revenue recognition standard is to recognize revenue when or as the entity satisfies a performance obligation. And this is important because you can recognize revenue over time. And this is something that really needed to be addressed for the construction and engineering industry to make sure there was some clear language around this. And as you recognize this revenue, as the customer obtains control of the distinct item or service that you are providing. So there's certainly a lot behind each of these steps. And we're going to go through a couple of these definitions that can just give you an idea of how complex some of this can be. So the first definition here, when you look at step 1, identifying the contract with the customer, you first have to have a contract, which is an agreement between two or more parties that creates enforceable rights and obligations. In a lot of ways, these are legally enforceable rights and obligations. But the contract, as you see here, we're used to contracts being written, but these can also be oral or implied, like when somebody calls and orders something or you order something online. Even if it's not completely written, it could be implied by the way you typically do business. So you have to think about the different states you're in and legal jurisdictions and the nuances of your industry, and we'll touch base briefly on the industry task forces and what they're working on. The next definition to look at is the definition of a performance obligation. Step 2, you're identifying the separate performance obligations in the contract. So here, a performance obligation is a promise in a contract with a customer to transfer to the customer a good or service, and it has to be distinct. As I mentioned, that concept of being distinct is very important, or a series of distinct goods or services that are substantially the same and that have the same pattern of transfer to the customer. So certainly these definitions, you need to keep those in mind as you're assessing this standard. Another definition to look at is contract costs. So the standard here says an entity should capitalize incremental costs of obtaining a contract and amortize it over the life of the contract. And as part of that, you would be recognizing these costs as an asset on your financial statements and on your balance sheet. These costs should relate directly to a contract, and the standard gives the example, as I note here, of commissions. It also goes through a number of other things that are direct costs, but a lot of times we just assume those, like direct labor, direct materials, costs that you would charge to your customer that kind of pass through. But commissions is a bit of a new concept for this standard. So it has to enhance the entity's ability to complete the contract. They have to be expected to be recovered during the contract. And it does say here that if you're going to complete a contract within a 12-month period of time, you can elect not to capitalize these costs and just expense them if that's an easier way to account for them during the year. So as I mentioned before, there's a lot of accounting standards updates that the FASB works on, and just related to revenue recognition, they've 2015-14 was the deferral of the effective date. 2016-08, principal versus agent considerations, so they have guidance there. Performance obligations are surrounding licensing. That has its own accounting standard update. Derivatives and hedging, which fall into topic 815. Narrow scope improvements, technical corrections. As I said, they're still working on refining this, and we have 16 industry task forces to help address a lot of the issues that they need to cover through each of these industries. So if we look to the next slide, we can look at what these 16 industry task forces are. And based upon the individuals participating in the webinar, there are 3 of these in particular that affect the majority of you. So you see I have highlighted here construction contractors, certainly ones when you think of percentage of completion accounting and how will that change and how you recognize your performance obligations over time and recognize them as you're satisfying them. So there's a lot of issues going on there. There's 7 in particular, and the task force has finalized 3 of those construction issues. So certainly keep that in mind. If you look to the healthcare industry is one of the industries with, they have 10 issues that are out there that they're really focused on. They've only finalized 2 of their issues, and one of those issues in particular was the application of Step 1, which was defining the contract. And making sure that you've entered into that contract. So you look at healthcare services, they have to have both the intent and ability to pay, and this really focuses in on those self-pay patients and the balances arising from either those co-payments or their deductibles, and do you actually know that that individual has not only the intent but also the ability to pay you. So in some cases, this can defer the recognition of revenue ultimately until the cash is collected in the most extreme circumstances. So something you need to look at as a healthcare entity. The other issue that they finalized in healthcare is the portfolio approach on how you can group your contracts and not necessarily have to look at every single one if their characteristics are similar enough. The other one to touch on here is the not-for-profit industry. So they have finalized 3 of their issues. One of them is that they specifically exclude contributions from the scope of this revenue recognition standard, and they're working on another project for that. Tuition and housing revenue is something else that they've finalized, and how you can kind of bifurcate and separate contributions and exchanges was the 3rd issue that they have finalized. So obviously all of the task force are working hard and are working on all of these issues and how they would be impacted. I just wanted to highlight those top 3 for those of you on the webinar today. As we move on, this is a revenue recognition topic 606. This comes from the AICPA's website and from their financial reporting center. The last they've updated that was June 1st, 2017. Following some of these task force a little more closely, a lot of them have things that are pending or they're trying to move forward, but you see off to the right which ones are finalized to be included in the guides. So a lot of these have some pretty significant gaps. As you see, engineering and construction, there are 7 issues, 3 are finalized. Healthcare, 10 issues, only 2 are finalized, and some of the other ones as well. You see some pretty significant gaps that they're still working through and finalizing the industry specifics for each one of these and how they will be impacted by this revenue standard. So that was revenue recognition in 15 minutes or less. As I said, we could spend days on that. So that is our high-level overview. If you are looking for some more specific examples of the construction, healthcare, and not-for-profit industry that I kind of touched on very briefly, we did do a webinar in June that is archived. You're welcome to go back and listen to some of those examples. That was 50 minutes just on revenue. So something to consider.